All right. Let's see here. Let's wait for the socials to go live. Get started. Hello, Smart Money Cheap podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hegren. Hey, Doug.
Good morning, Kirk. How are you today? Merry Christmas. Hope you're enjoying a little bit of a rest and relaxation as we wind down the year.
Yeah, Merry Christmas and Happy Boxing Day. That's I'm not familiar with where that came from, but I believe it's in the UK. The wealthy felt guilty, so they gave all their servants stuff in a box, food or extra food or whatever it was. That's my understanding of it. I could be wrong. I'm not English. Well, I am, but not that English. So yeah, it's a good day for recovery, depending on what kind of family gatherings you had, or reflection, which I think this week and next week are great times for reflection. We talked about it a little bit last week, but I think this time of year is my favorite time of year. The last 2 weeks is I just kind of take it light and just focus on reflecting on the prior year and what I want to do in the next year. I get this whole process built out. I've done over the years has had a huge impact in my life. And a lot of it's just, spending the time to do this. And I'll talk about it a little bit because I think it's a wonderful process. But, if next week people are going to be doing their New Year's resolutions, why? Well, because everyone else is doing it and you feel like you need one so you can talk about it in the, at the coffee machine at work. Well, the reality is New Year's resolutions are worthless in the way that most people do it. Most people just say, yeah, I want to lose 20 pounds this year. Or I want to make $100,000 more this year than last year. Or, I want to spend more time with my kids. Well, if you don't have a process or a plan built out around that, it's never going to happen. It's what we call a wish. A wish, it does not happen, right? If you want something to happen, you have to put a framework around it to make it happen. So, one of the accountants I know, I was talking to him earlier this year, and he felt it was really important for him to lose a certain amount of weight. And I said, well, great, man. How are you going to do that? He's like, well, I'm going to lose like a pound each week, or whatever it was. I don't know the exact number offhand, but I want to lose a pound each week. Okay, great. And he built a framework around making that happen. And so every week he lost a pound, 2 pounds. He didn't try to lose 20 pounds in a week. He said, I'll do 1 a week. And, figured out all of the different things he had to do to lose that weight. Went to the gym, got a trainer to make sure he went to the gym, got rid of all the junk foods out of his house, started to eat healthier, all the different things you have to do that. The problem is if you just show up and, New Year's Day and you're like, all right, I'm going to start losing weight. Well, I'm going to start tomorrow because today we're drinking with the family. And then tomorrow happens. Well, tomorrow's Friday. Well, I don't know. I got to go out with the friends after work. Maybe it'll start on the 3rd and then the 4th and then the 5th. And then, 2 weeks later, you're like, wow, I just gained 5 pounds. What happened? And, the problem is that it's not supported by any sort of plan, any sort of structure, any sort of habits, right? Like if you're trying to lose weight, well, why are you overweight? There's probably reasons for that. And it's not just genetic. There's probably reasons for that. You're probably not going to the gym. You're probably not, you're probably eating unhealthy. Maybe you're not sleeping enough. Like there's a whole bunch of reasons why that can happen to people. And so the question is, why is it happening? Okay. So what structures do you need in place to make sure that happens? Sleep more, eat healthy, get rid of the junk food out of your house, get rid of the temptations, if you will. Make sure you're walking a mile a day or whatever the thing is. But the point is putting these structures in place to make sure that you're seeing the success that you want. Now, you can apply that to anything. You can apply that to making more money at work. You can apply that to being more successful in the stock market. You can apply that to just about anything, right? But if you just wish it to happen, it won't happen because your brain doesn't make it real. Your brain thinks it's BS because it is, right? You just threw something at a wall and said, this is what's going to happen. Let's just do this thing. So if you want to have success this year, what you need to do is you need to put together a framework for how you're going to do it. Say, I'm going to do this goal. Here's how I'm going to accomplish it. So let's say this year you want to have more success in the stock market. Okay. Why are you not having success now? Like, what's getting in your way? Could it be that you don't know what you're doing, right? You don't have the educational framework, or you don't have the experience, or you don't have a plan in place, uh, or whatever, right? You don't have enough money. Like, it could be lots of reasons why you're not having success. So first thing is figure out why you're not having success. Second thing is, what do you need to have in place to have success? Right? Do you need better habits? Do you need more education? Like, all these different things. And then the third one is is putting together a strategy to make sure that you not only have your plan but stick to it. And so there's a whole framework, and it'd take me way too long to talk about in the show, but if anyone's interested, just let me know. But the framework is around structuring your best habits for the year so you can start having success. Now, this is an investing show, obviously, and personal finance. So, there's a lot of things wrapped into that. It could be you want to you want to save more money this year, then you're not saving enough. It could be you need to put a plan in place because you don't have a financial plan. It could be, you need more money for your kids' education, right? It could be anything. Most people want to invest better. Well, that's hard because even smart people lose money sometimes. But what I think is important this time of year is to reflect on what you're doing now. Is it a process? Is it repeatable? Is it showing you success? Where is it weak? Like, where are you stumbling? And what can you do to make it better? So, for example, let's say you're trying to day trade and you're not equipped for that psychologically. Like, you're more wired like Warren Buffett. Well, day trading is not a good idea. If you need action every day, then day trading might be more your speed. I would argue that for most people, day trading is not a good idea. For the vast majority of people, it's not a good idea. I don't care how many ads you saw about you can make $1 million in a day trading. Don't do it. I'm just telling you, in my experience, I've never seen a successful day trader who's been successful over long periods of time. Now, there are people who have some success, but the amount of time you're spending and the output, it's just not worth it, especially if you have a full-time job. Don't do it. Now, if this is your full-time job and you're having success, good for you. But most people are not going to do that. So don't buy into the easy money, shiny object syndrome that everyone pitches, that, hey, everyone can do this. Not everybody can do it. I couldn't do it. I tried to do it years ago and test it. And what I realized was I was wasting my entire day, and I was stressed out and I couldn't sleep. And I was just like, I can't do this anymore. This is unhealthy. And I just stopped because I wasn't wired for that. I thought I was, but then I realized this is not healthy at all. Like, it's going to destroy my life on every other aspect except for this, and I'm just not doing it. So I had to redesign a strategy that worked for me, that I'm comfortable with, and I found a bunch, and they're great. But it took me years to figure that out. It wasn't just an overnight success. It took a lot of failure, a lot of trial and error, and a lot of discussion with smart people, figuring out, like, okay, for example, like stop losses. Stop losses are a great risk management tool. Well, the problem is, if you put them in the market, the market makers and the institutions, they see them and they take them out. They target those because they know it's easy money. And the stock or the investment you have will drop to your stop loss. It'll trigger it and it'll go right back up. So it doesn't happen with highly liquid investments, like the Mag 7, but it does happen for a lot of investments. So you can't really put your stop losses in the market. Well, if I don't have them, then I have to keep them in my head. Well, if I keep them in my head, then I start to rationalize, oh, well, I'm just going to wait. It's a little bit lower. I'm not going to sell yet. I'm just going to, and you start having a psychological game with yourself. Well, it'll bounce back. And then 20% lower than where you wanted to sell, you're like, oh crap, I should have sold. Well, that's a problem, right? So for me, I use options as a way to create a stop loss. It allows me to game the system. It allows me to manage risk, and it allows me to be very, very wrong and still be protected. And even if, if we make up in the market tomorrow and the market's down like 20%, I'm okay. You can't do that with a stop loss. Stop loss would have got triggered a lot lower. For me, like, I'm protected. I'm okay. I can sleep well at night. I don't worry about it. I don't worry about if I miss a day in the market or two or whatever. Like, it's protecting. So I've figured out where my weaknesses are and where my strengths are, and I designed strategies around that so that I could have success in my investing. And Doug has a different way to do it. And Phil has a different way to do it. And Barb and Diana, all these people have different ways of doing it. And it works for them, right? We have Diane in the show. She actually teaches people how to trade, which is great, especially women. She specializes in focusing on women, but she does work with men too. So somebody like that is great, right? She coaches people on how to invest, and she helps people invest better. Those things are really important to figure out, right? You just sticking your money in the S&P 500 has had a lot of success in the last 15 years, but it doesn't mean it'll be successful in the next 15. Okay. I'm going to share one chart to illustrate this point because it's actually been out a lot, and this is one thing I want to share today. And there's a few versions of this, but basically here's how you disentangle this chart. So on the x-axis, it is the forward PE ratio. It goes from 10 up to 24. On the y-axis, it is a 10-year subsequent annualized return. So what you want is, you'll notice the line goes from the upper left to the lower right. And there's a regression chart. Sorry, can't speak today. So where we are today is the red dot, which is forward PE of about 22 and change, and the annualized 10-year annualized return is negative. So here's the point of this chart, especially for the audio viewers. If you have a low PE, your average annual return is really in the 10 to 20% range is what you can expect. If you're in the high PE, your returns expected are close to zero or negative in the case of this dot. Now, I've seen a lot of versions of this, so you've probably seen a different one, but this is the kind of thing we look at. So when we look at the markets and say the markets are expensive, you say, well, expensive how? Well, there's actually a bunch of reasons it's expensive, and there's some reasons where it's not. But in general, if I'm looking at this, I'm saying, all right, according to history, according to the data for the last 100 years, this is an expensive market. And for the next 10 years, you should expect a 0 to -% return over a 10-year period. Doesn't mean that's going to be tomorrow or the next day or next year or whatever. It means over a 10-year period, you should expect negative returns. And, I've been seeing these a lot lately, and I don't want to say I can validate these, but in my experience, this tends to be true. But it also tends to be true that the markets could keep going up for a bunch of years. That's also potentially true. So it's something to keep in mind. You have to have a strategy that allows you to have your cake and eat it too, because this is not going to be an easy market over the next 5 years. I would say it's going to be a very challenging market. And there's going to be a lot of, let's say, discrepancies that won't make sense. Like, I don't know, platinum going up 11% in a day like it did a few days ago. If you guys didn't catch this, I almost didn't catch it. But yes, platinum went up 11% in a day. Like, I think it was on like the 22nd, somewhere like that in December, 22nd, 23rd. Anyway, I barely caught it, but it was up 11%. And I was like, oh my God, this is crazy. So just keep in mind, you might see a lot of that stuff. We saw that in precious metals this year, and you could see it in other stocks. We saw it in AI stocks. We could keep going higher, but we could also go a lot lower. So for those of you who've never seen a bear market, never seen a recession, it's been a while, so a lot of people haven't. Just keep in mind that things don't go up forever. And when they go down, it's going to be extremely painful. And you're going to feel like the world's ending and, oh my God, I'm never going to be able to retire and all the bad things. And if you feel that if the market went down 5% this year and you freaked out, you need to lighten up on equities. Okay. That's my professional opinion. If you're 100% in equities and you could take a 20% drawdown and not bat an eye, okay. But if you can't take a 5% drawdown and you're like 50% equities, you need to lighten up. So this is the time of year to reflect on things of that nature. It's time of year to reflect on, are you, if you're in greed mode, meaning like, oh my God, I need more. I don't have enough precious metals. I did great this year. I need more. You need to make sure that you believe that. What if they went down 20%? Like they did. They went down a bunch like about a month ago, and people freaked out. If that was you, you need to lighten up, not increase your percentage. So it's hard to do in a bull market. It's hard to think about that. Most people just put the pedal to the floor and say, let's see how fast it can go. The problem is you end up with a wreck at some point. So you got to be really careful. You need to find ways to make money and be happy with the fact that, look at your portfolio. Say, all right, let's say I'm 50% in silver. And by the way, don't ever do that. But let's say you're 50% in silver, because silver's up like 120 or 130% this year. And let's say for a moment that you look at silver and say, what would happen if silver dropped 50% right here? What would I do? Well, if your portfolio is 50% and it dropped 50%, that means your portfolio dropped 25% in just that one position. Can you handle that? That would be very difficult for me to handle. But if you can do it and you're just going to say, I'm going to ride it to the moon, okay, just don't look. But at the end of the day, most people can't do that. So you need to stress test your portfolio. You need to think about, is this position too big? What if it drops? What if AI blows up? What if it goes down like 30%, 50%? What would you do in your portfolio? Would you be okay with that? Are you too heavy in some of these names? There was one name I saw went up, I don't even know what percent. It was a few 100%. It was like an AI name. And then it's down like 70%. Well, if you get in too high, you lost a lot of money. Maybe it never comes back. So you need to think about these things. Don't just be a pig. Don't just drive around with your foot on the floor. Be mindful of the risk you're taking, and stress test your portfolio. If you don't know how to do it, you can message me. We can talk. But there's maybe I'll talk about it in the show next year. Anyway, Doug, what are some of your thoughts?
Well, yeah, a couple thoughts, and I want to go back to. I thought you made a really good point, and I'm not going to dwell too much on this, but you were talking about stop losses, and I've mentioned this before with stop losses, and you talked about market makers, and I think it's really important to understand, especially for those of you that are out there trying to use these, which a lot of people who do trading themselves do take advantage of these. But most people who are trading themselves, let's be real, are spending a lot of time trading ETFs, not necessarily trading individual stocks, although that obviously does occur. But we live in a world where the passive index ETFs are really becoming king, and the issue that you get with stop losses is what you started to mention. It's where a trade executes at a price significantly different or worse than the stop price, especially in volatile markets or price gaps. It's called slippage. And the issue with ETFs is that ETFs, unlike regular stocks, still deal with these market makers, and they're crucial to that ETF system. And that ensures that there's going to be liquidity, and that as long that the ETF's market price, which is part of the mandate of ETFs, stays closely aligned with net asset value. This is because with ETFs, there's some underlying rules that mean that you can actually get be given the underlying portfolio of stocks once you have a certain number of ETFs, which I believe is around 25,000 shares. So you can actually say, I want the stocks instead. And so they have to keep those ETFs closely aligned to net asset value. But the impact on stop loss orders in that area is that they can sometimes infer where large clusters of stop loss orders are placed, like you said, just below, say, a key support level. And in a less liquid or volatile market, they might actually gun for those orders, pushing the price to stop level to trigger a wave of those market orders, which then they can use to fill their own positions at favorable prices. And that can actually exacerbate those price movements and lead to stop loss orders executing much worse than anticipated, and that can lead to larger losses or selling at market's temporary low point. So while the retail investor has gotten the ability to be more directly involved in investing, one thing the retail investors have typically not gotten in that world is the education. If you go back to the investment industry, which used to be where most trading occurred for clients, they would be working with these investment companies that ran the mutual funds and ETFs, and one of the things they would do is educate them a little bit more on how they work, that the public now has to go out and find for themselves. Unfortunately, they don't generally get that level of education. One of the first things that they taught in ETFs in the world is do not, or it is highly recommended not to use stop losses when you're dealing with ETFs. So they work really much, much better if you're working with individual stocks. But if you are working with ETFs, it creates a tremendous amount of risk. If you want to control the price a little bit more than the execution, one thing you might look at that would, instead of a stop loss order, is a limit order. That allows you to sell or buy at a specific price or better. That will allow you then to be able to have that order go and go through if it hits that price. The thing is, unlike a stop loss order, which guarantees an execution once that stop price is hit, but not at a specific price. So if you set the price to the stop loss to 65, and it falls 63, boom, market order, it's going to get filled. Well, if it drops like a flash crash to 45, it's going to sell at 45, and that can be a tremendous loss you weren't expecting. Thinking, oh, I'm protecting myself. I wanted it, let's say it's at 70. I want to get out at 65. I set the stop loss. If the opening order price is 45, that's what you're selling at. Limit orders allow you to really lock in that price. I want to sell at 65, but unlike the stop loss, there's no guarantee of execution. The order is only filled if the market price reaches your specific limit price or better. So you have a lot more control in a limit order than you're going to have in a stop loss order, which allows you to trade at your set price or more favorable one. Now, the risk on stop losses, as I mentioned, is slippage, where it executes a tremendously lower than you were hoping it would be. The risk on a limit order, which Kirk you were talking about having to watch closely, the stress of that. You still have to watch closely. You still have to make sure that you're on top of it, because the risk on a limit order is that you'd miss a trade opportunity if the price moves quickly past your limit without a fill. But at least you're going to be able to maintain control of that price and that execution. With stop loss orders, that comfort, or that you might believe you're getting by having that in there, could actually give up a lot of control and guarantee an execution at a price that you're not happy with. So, really make sure you do your research on this. You were talking about platinum, Kirk. I actually posted a picture. Some people are aware of this, but because of where precious metal prices have gone, Costco has gotten into the game of selling precious metals. And it's hard to find. Not every Costco location has it. I was actually at our local Costco the other day, and I took a picture of a sign that showed that this location was selling the 1 ounce gold bars. Currently, at that price, was $44.89.99 per 1 ounce. But it has become so popular at Costco for individuals trying to take advantage of this opportunity. By the way, getting a little more coffee here. I just want to point out, education is important, but tennis is importanter as we get into the depths here. But ultimately, they had to put a limit on this. There's only 5. They will only allow you to have 5 of these with no returns. I think it's kind of funny that, you'd buy a bar of gold and go back and say, well, you know what? There's something wrong with this, Costco. We want to take advantage of your refund policy for your bar of gold. But anyway, again, you can buy an ETF. You can go to a gold dealer. Well, Costco right now, you can actually, if you really want to have the feel and the weight of an actual 1 ounce gold bar, check your local Costco because it might be there at a slight discount over the current futures price. But know that if you're trying to bank your future on it, they will limit you after 5. Speaking of rapidly changing prices, Kirk, I know it's kind of a running joke that we have here now, that occasionally I do bring up the conversation around illicit items. So instead of heroin today, I'm going to talk about cocaine. It turns out that it's funny. I've been watching a series, and if you really want to see, you're into history, there is a show on Netflix. It was originally 126 episodes, but I think they've condensed them down to about 76. It is in Spanish. I had some friends of mine who were Jewish, Russian Jewish, that could not speak a lick of English before they came to the United States. And they actually found that they actually learned English by watching American programming on television and following the closed captions. Well, I am now 64 episodes into this, which is all Spanish with English subtitles. I'm actually starting to understand. I'm almost to the point, Kirk, where I'm about 10% fluent on Spanish now by watching the show. But it is Escobar, El Patron de Mar. It's I think I might be saying it wrong, but basically it is a Colombian series produced in Colombia with Colombian actors about the rise and fall of Pablo Escobar. It's fascinating. All of the stuff they did, I highly recommend. It's a really good show. Way better than Narcos. If anybody watched Narcos, it's good, but that was really American streamlined. This one gets really into the depths. But my point of this is talking about rising prices. If you're trying to invest in one thing and you're trying to invest heavily in the S&P 500 and you think that's going to be, or silver like you're showing here, well, it turns out that if you are a bandito, and you are one of the cartel, and you're 100% invested in cocaine, you're struggling right now. Turns out that the prices have plummeted so much to the point of oversupply that they are now saying that one of the ways that they're getting cocaine into Europe has been through the use of submarines. And this is something that Escobar and a lot of the cartel used to use, is they would make so much money that they would fly a plane or a submarine, and then they would just scuttle it. The price of a new plane wasn't worth trying to get that plane back and reuse it. They would actually just trash it because they were making so much money. Well, it turns out, Kirk, that the poor cartels now are actually saying that they might have to reuse those subs, that the price of cocaine has fallen to the point that they can't just sink their submarines anymore. They might have to learn how to recycle them to get more cocaine into Europe. So this was in the news this morning. I think it's funny. So again, diversification is important, because clearly if they're fully invested just in the price of cocaine, those poor cartel are struggling. But I really want to segue this back.
Well, before we segue, Doug, the question I have to ask is this. How would they know that? This to me sounds like a made up story, because how would they get that information? You think the cartel's like, oh, let me talk to my connection in the media. It's total BS.
Well, Kurt, there's the rumors out there of the CIA involvement in the drug cartels. Maybe our own government is getting this data because they're actually involved in the transactions. Yeah, go get your foil hat on.
Yeah, seriously, it's not even that. It's just BS. You can smell it a mile away. There's no way they have that information unless it's planted information, or they're just or they're on their B crew and they're just making stuff up just to make up stories, which is probably more likely the case. So
it is possible, and not to beat the dead horse too much, but it's also possible that based on the number of informants that are in there that they're working with, they might be getting some feedback underground. But regardless of, the one thing they can track is the price of cocaine. It has plummeted. So if you're all invested in that, all in one thing. And speaking of that, where I want to tie this back to actually more of a valid point for today's conversation, is that there's actually that they actually have looked at some calculations. I had it up here, and of course I move things around, and then all of a sudden I lose it. So let me pull it let me pull it up here. But so there's the gentleman that ran a calculation basically on if you had been fully invested in just the S&P 500 and you had retired in 2000. Now, I'll tell you, I haven't crunched these numbers to validate them. This was a CFA that did this, and they tend to do a pretty good job at running these numbers. Again, we've talked about plenty of chart crimes, but basically this individual came up with is if you retired in 2000, similar to stock valuations today, and you retired with $1 million, and you were needing $50,000 a year plus inflation. Now this would be 5% per year. If you had put it solely in the S&P 500, you would have run out of money by 2016. If you had put it into a 60-40, which is 60% S&P 500 and 40% total bond index, you would be down to 199,000. So you're about to go broke, but you'd be better than if you were fully invested in just the S&P. And then if you would put it into an all-stock asset class portfolio diversified across the U.S. and international large and small value, you'd have about $2.9 million left. In other words, in this case, tripled your wealth. So the point here was retiring on anything other than a diversified asset class portfolio, you're taking huge risk of running out of money. Now, Kirk and I have talked about diversification and, pros and cons of it. And again, do I think you should just sit in a 60-40 portfolio given the way bond prices have been and the impact of interest rates? No, we are not believers in just sitting on a static portfolio. But there is some validity to this argument, which of course comes into the fact that we've talked about this. The S&P 500 was terrible for most of the beginning of this millennium. As a matter of fact, it's negative for the first 13 years after the dot-com implosion in 2000. And actually, it took until 2018 for your average return from 2000 to get back above 5% a year. That's the amount of volatility, the impact of that volatility. So we have had an incredible run in the S&P 500. Matter of fact, we're going to end the second year, we talked about this last week, with double-digit returns that are in the 20s to 30% range. I mean, massive blow up. And we have a generation of people who have never lived anything but an incredible run in the S&P 500, especially coming out of the Great Recession in 2009. But this is absolutely not unusual either to go through, and you were talking about the cyclically adjusted price to earnings and the impact of where the market is and where that has, where Shiller has computed that the longer term returns tend to be lowered significantly when you have, valuations that are higher, and again, it's certainly not a guarantee. And as you said, who knows, we might have several more years. I mean, you go back to Greenspan and irrational exuberance. He made that comment in around 1997, and look how, 96, 97, look how long it took for the market to actually react. I mean, we could have, many, many more years of great returns. And we talked about this last week. If you have 2 years of double digits, generally the next year has historically looked pretty good. But the global financial crisis and the returns of the S&P 500 from 2000 to 2013, and really from 2000 to like the late teens, was pretty anemic, and that is not unusual. We actually, if you skip the boom of the 90s and you skip the boom that we've had since then, we can go back to the stagflation era, which was roughly 1968 to 1982, where we had high inflation, very similar to what we're feeling now. Interest rates spiked to 17% in 1981, and inflation peaked to 14% in 1980. We're definitely feeling the inflation if we look at things that we need. Interest rates certainly have not gone up. The government has lowered them again. So we're not really in that stagflation impact there. But the inflation adjusted annual stock return was between 68 and 1982 was only 0.8% per year. So you're talking about 14 years there where the S&P 500 was doing less than 1% a year. Now compare that to 14% from 1983 to 1987. So, again, a lot of people are listening are younger, have not experienced a major pullback, a true risk in the markets. It's always there. We've been on a fantastic run. We have been on these fantastic runs before, and this is where Schiller's information has proven true, is that if you look at the boom prior to 1868, then all of a sudden we got into that inflationary of low returns. You look at the boom after that, and then we ended up with the 2000 to 20, to 2013 to 2018 range. Again, it has proven time and time again that diversification. Now, if you're fully diversified sitting in it, not what we recommend, but being very mindful of where things are, where valuations are, adjusting, repositioning, focusing, being very mindful of what you have and being willing to adjust that mindset, critically important, because history has shown repeatedly that we will go through these periods and likely go through them again.
Yeah, it's good insight. I want to actually share something with people because we see these kind of things a lot. And as I was kind of looking at some charts this week, I started to laugh because, there's some simple things when we talk about chart crimes, when we talk about people kind of creating narratives instead of actually sharing facts. Here's a good example. Most people don't know the difference between median and mean. Okay. Yeah. And so this is a chart. Is just a generic chart. I'm not sure if it's accurate. I don't really care, but I'm using this as an example. So
at least this one goes back further than 5 years. For one.
I don't know how far back it goes, Doug. This is this is.
I was thinking. I was reading it
as
1920. You're right.
No,
my point. Good point.
So the chart is average net worth by age. So it goes in the 20s, 30s, 40s, 50s, up to the 90s. And you see a bar, which is the average net worth, and then you see the median net worth, which is a point. Now, I share this, and I'm going to share one more because I want, when you look at data, you have to understand what they're actually sharing with you. Now, here's an example. So people in their 50s, the average net worth is $1.4 million. We might think, well, that's crazy. I don't know anyone who has that. Yeah, well, there's a reason for that. The median net worth is $288,000. That sounds a little bit more in line with where people are. Now, here's the difference. The median net worth is, well, let's start with the average. So the average net worth is taking everybody and averaging out the numbers. So the 1.4 million includes people like Elon Musk, includes a lot of people that are really worth 100 million or $1 billion in their 50s. It includes them. And it obviously includes people with zero net worth. So the average of all those people is 1.4 million. Now the median is 188,000. Now the median is effectively used for skewed data, like income and housing prices. You might say, well, the average housing price is $1 million. Well, okay, but there's people who have houses worth 100 million. So if you're looking for the average, you don't use average for let's say data that's skewed, okay, where there's an old joke of the average net worth of people in the bar is 100,000. Then a guy walks in the bar and the average net worth 10 million. It's like, well, Bill Gates walked in the bar, right? So you can't use average if you're looking at data sets. If you're looking for median, that's a little bit better. You're basically looking for the midpoint. You're getting rid of the extreme values in the mix. So I only point out that framework. If you want more information, you can go look it up. But use this framework when you're looking at data sets, and don't get bamboozled because somebody said, "Oh yeah, well it's the average," and you just get taken to the cleaners because you took that for gospel. Now I'm also going to point out a second one because this comes up a lot. If what you tend to see is there's also this other framework which we call arithmetic mean versus the geometric mean. Okay. Now, arithmetic mean is great for typical averages, right? Like a test score or something like that. But if you're looking for investment returns, you can't use average returns for if you're, let's say you're trying to take the last 100 years of data. You can't say what the average return is over 100 years, right? You want to use the geometric mean. Now, the geometric mean tends to be lower. It tends to be a lower number than the arithmetic. They're similar, but it'll tend to be lower because it accounts for growth rates and ratios and things like that. So if you are using this for investing, like averages for investing returns, things like that, you are using geometric mean. So these are two simple statistical things that people can use to play with numbers. And if they want to make the numbers look good, they might use an arithmetic mean, right? If somebody's showing you their average portfolio returns, they might use arithmetic mean because it makes the numbers look better versus geometric mean, which is actually a truer number, right? So if I play around with a lot of data sets. So if I'm using that and I'm looking for like the last 100 years of data, I'm using geometric because it's more accurate. So these are two small things that can help you, let's just say, find a little bit more accurate numbers and make sure that someone's not taking advantage of you because of that. Now, I'm gonna reshare a chart I shared earlier this week, and it's the $20 St. Gaudens MS64s. Now, I shared this earlier in the week, and I shared that it had a 9 or 10% premium. At the end of the year, I typically will buy some gold coins, and so I'll go out and buy coins, and usually do it for weight. But as I was doing some research, I noticed these, and I figured, oh, all right, well, this is historically low. I'll go grab some. Well, it turns out the premium's actually close to zero, so I got mine for spot price. The premium over gold content was basically at the spot price, which means they didn't have any premium built in there. So I don't know why. It was weird, but I'll take it. And so my point is these are actually lower than I thought. You can get these depending where you go, right? A lot of people will take advantage of you, but if you go to good places, you can get them for right around spot price, which is great. Now, the advantage is if gold goes nowhere for the next 10 years and people start to want to get these, well, now the premium gets up to 30 or 40. So I could make 30 or 40% if gold price never changes and the premiums start to go up. Now, I'm not saying they will. I'm not speculating on the price of either one, but if you can't go lower than zero, because if you do, you just melt down the coins and you just sell the gold at spot. And so spot's really the lowest price you can go, right? You can't go, if you go below, buy as much as you can, right? It's like there was a time where junk silver, there was a discount of like 20% to melt. I bought some silver back in, I forget when it was in the teens. I forget the exact year, but it was somewhere in the teens, 2000 and teens, where the melt price of junk silver, and if you don't know what junk silver is, they're pre-1965 coins, like quarters, dimes, half dollars, and they're 90% silver. So if you look at that and you take the weight, you got to do a little calculation, but there's a lot of online calculators out there. What you could do back then is I could have taken all those coins and melted them down and sold them for the spot price. So I forget what it was at the time. Let's say it was $20, and you could buy junk silver for 16, and it would have been 16, 90% of 16, whatever that is. So it would have been whatever, 14.7, something like that. So it'd been $14.70 you could have bought it for. And then you could have melted it and then sold it for 19, let's say. I know my numbers are a little off, would have been 18. But anyway, you could have made money just by doing that. Now it's illegal to, by the way, it's illegal to melt those. It's illegal to destroy U.S. currency, according to the law. I'm not sure. Basically, the people who melt it won't melt it. That's the result of that. They won't melt it for you. But if you could find somebody who's maybe a little bit questionable who could do it, you could make a lot of money just doing that. There was a time where Kyle Bass, hedge fund manager, really smart guy, who found there was an arbitrage of nickels. And so at the time, you could have the price of nickel was below 5 cents. So you could have bought, and this is the old nickels that were made of nickel, right? And I don't know what they're made of now, but when they're made of nickel, you could say, well, they're made of nickel and they're worth 7 cents, and you can get them for 5 cents. So what he did is he requested like $5 million of nickels. And the bank's like, we don't have that many nickels. So they had to call up and they had to order them. So they had to order them from the mint. And they're like, well, we need to know why you need this many nickels. And he's like, I like nickels. It's kind of funny that they would even ask. But the point is he arbitraged. He bought a bunch of nickels and sat on them. And, I don't know what he did with them. But, if he had enough money, which he does, he could just go, find a smelter and just melt them and melt them into like nickel bars or whatever they do. Anyway, the point being is it's interesting to observe the discrepancies in the market, which normally should not occur. This, which, like I said, it's zero now from the way I understand it. This should not happen. All right. This is a rare coin, which is, I think the MS65, I think is the highest, and this is just a tad below. This shouldn't exist. There should not be zero premium over basically spot price. It shouldn't happen. But when it does happen, you want to be aware and you want to take advantage of it, because at some point it will go up in price. Now, you got to have a good reputable coin dealer, by the way. If you don't have one, they will take advantage of you. So if you don't know anything about coins, just buy sovereigns, just buy Golden Eagles, buy Maple Leafs, buy Cougarans, buy Philharmonics, buy the sovereign coins, because there's a very clear commoditization there. They're X amount over spot. That's it. Everyone sells it for that. You just want to find the lowest price you can get. Those are different. Okay. This is something for people a little more advanced. So I'm only mentioning it because the opportunity is out there. I took advantage of this a few days ago, and I buy a few coins a year, so I'm not going crazy, but it's something to observe in the markets. I'm basically getting it for spot price, so what do I care if it's rare or not? I could easily liquidate it for spot price. So anyway, just for those of you who are not aware, who are interested in precious metals but maybe not aware of what's going on, you should pay attention. As I showed earlier in the show, platinum has gone crazy. I think today platinum is up. Where was it? It was up 9%, I believe. Platinum is up. 10.5% today. Platinum's going nuts. And let me just kind of talk through why. So as we mentioned in the show before, gold starts the run. For precious metals, gold goes first. So gold has been doing really well for the past 2 years. It just keeps climbing. It's done well this year. Silver started to pick up right around, really picked up in September, but it was kind of flatlining until kind of June. And then it broke out, and it just keeps climbing, and it's gotten more and more progressively parabolic. So you want to be careful in the calendar year whether this is not sustainable. I'm not saying it won't keep going higher. I'm just saying it's not sustainable. This is where you call a blow off top, and it may happen sooner than you think. So just be careful around precious metals. If you're taking risk, make sure you're either watching it closely or using options as a way to as a stop loss, as we talked about earlier. But platinum actually just started to take off a few weeks ago. It started to take off on the 15th. It broke out on the 15th, 16th, 17th. I'm sorry, 15th or 17th. It broke out. So it broke out and it's gone parabolic. It was right around 1800, a little less than 1800. Now it's at just shy of 2500. And that's within like a week or two. That's within a week. So, or 10 days, right? So you want to be mindful. Also note that copper plummeted in August, and copper has gone from 4.4 up to 5.8 today. It's actually up 5% today. That is not common for copper. So just kind of be aware of these things. Point being is you want to be really mindful of what's going on in the different areas of the market. Oil We're going to do a wrap up next week of kind of like what the year's been like, or yeah, next week of what the year's been like for different prices. But if you're looking at oil prices, and basically if you're looking for oil, you're looking at heating oil, natural gas, especially crude. Crude is at really close to multi-year low. You know, it's at 57.67 right now. I think the recent low about a week ago was at 55. There seems to be a lot of support at 55, but you know, if you're looking at these prices, just be mindful. A lot of people are talking about how energy is going to start to pick up. It isn't yet. Remember, we do have a midterm election coming up, and there's a lot of incentive for the Republicans to keep oil prices low. So that means they might, you know, they'll probably make some political deals to keep them low so they can stay in power. That's how politics work. Heating oil is also relatively low. Natural gas is not as low. It's kind of mid range. But anyway, so just something to keep in mind when you're when you're looking at commodity prices. Just be mindful that there are certain opportunities out there that you might want to be aware of. I know the ag sector was not doing well up until the summer, and it's starting to do better. So anyway, I'm going to give it to Doug to wrap it up. But yeah, just stay frosty out there. Go ahead, Doug. Take us home.
All right. So a couple of things because you know to talk about. So you were talking about the illegality of mutilation, diminution, and falsification of coins. It's actually 18 U.S. Code 331. But what's interesting about that, excuse me, is that 31 CFR 82, which was issued by the U.S. Treasury in December 2006, explicitly banned the melting and export of 1 cent coins, pennies, and 5 cent coins, nickels, unless granted a specific exemption because those metal values approach or exceed a face value for pennies and nickels. However, and this is an interesting caveat, pre-1965 silver coins are not restricted from being able to smelt them and reuse them, as long as they are not being done so for fraudulent intent or trying to do any kind of counterfeit. Pre-1965 silver quarters were treated differently because they had been removed from circulation by policy, not law, and then that knowingly allowed them to be hoarded, traded, or melted. No subsequent regulation was ever issued to prevent that melting. So refineries will openly accept them. Coin dealers will melt them. ETFs and bullion programs legally process them. And you know, if this was illegal, the bullion industry around junk silver would not exist, which it does. So hey, so if you've got some pre-65 silver coins out there, and you really like go back to the Costco, you really like the idea of a bar, and you want to have them smelted in, those are accepted because they are 90% silver, post 1965 quarters, copper, nickel clad. Again, both are declared 25 cents, but obviously silver value is way over 25 cents, and they have been hoarded since then. So anyway, the government removed them from circulation. So there you have it. It's the failure of the peg. So there are some exceptions out there. Also, one quick thing I wanted to note, and I did have a chart on this. I've talked about this a little bit. This goes back to education, colleges. Back in 2013, 2014, if we start then, there was about 55,000 employees, and there was about 517,000 students. And this was staffing versus enrollment trends. Los Angeles Unified put this together through the California Department of Education data quest. Since then, the number of employees has gone up to about 66,000 by 22-23. The number of students has actually fallen by about 25%, down to about 385,000 students. I've said this before, and this is really important to note, that this is a slight trend that was occurring that has now that if we look at the next 3 to 5 years, we're actually going to start to see this change from being a slight trend to actually falling off as a cliff. because we saw that there was a huge decline in the number of births, sharply after the Great Recession, 2008 to 2011. California's decline was deeper than national average. Ultimately, the smaller birth cohorts hit kindergarten around 2013 to 2016, which we're already seeing, middle school and high school by 25 to 2028. So they're losing entirely smaller generations. Again, this is going to lead to profound effect, in terms of colleges, in terms of enrollment. Ultimately, we've seen about a 25% decline since 2013 to 2014 in this chart. Staff, though, up approximately 19% over the same period. So forward looking, the funding follows the students. Labor contracts lag enrollment. Fixed costs aren't going to shrink gracefully. So we're going to potentially see some ugly some ugly political stuff and potential impact to colleges coming out of these birthing trends. So to close this out, we've talked about a lot of things. We're winding down the year. Our next conversation is going to be after the new year, and it's always a fun one because we get to talk about how things ended up and predictions. But as we close out and look straight into 2026, this is the moment that most people get wrong. Everyone talks about, as you've mentioned, Kirk, lots of New Year's resolutions. Most of them fail for the same reason that crash diets fail. They're reactive, they're extreme, they're emotional. Even Oprah Winfrey was open about this with her crash diets that seem to be in the news every couple of years back in the early aughts and late 90s. Those drastic diets, they don't stick. They do work briefly, but then the reality takes over. And without structure, consistency, and a system, the weight, or in this case, financial problems, comes right back. Money works the same way. Smart money doesn't lurch from decision to decision. Smart money is going to react and reposition before the calendar flips. As I said, on my desk, I've got a mug that says education is important, but tennis is importanter. It is funny, but it also makes a point that college matters, retirement matters, legacy matters. What matters most is whether the dollars assigned to each goal are actually positioned to do their job without one silently draining the others. And too many families are going to head into this new year with everything blended together, retirement assets exposed to unnecessary risk, college tuition riding, market volatility, taxes unmanaged, estate plans disconnected. It's going to work until it doesn't. And then when it breaks, and it usually breaks later, when fixes are more expensive and options are fewer. This year end isn't about dramatic moves or predictions. It's about focus and structure. It's about trimming gains a little here, a little there, harvesting losses a little there, repositioning risk deliberately. And when those small decisions are made inside a coordinated plan, that's when they compound to massive outcomes over time. And this is why we're different. At Mergent Advisors, we don't manage accounts in isolation. We help families clearly see the entire financial picture, then design a structure around retirement income, college funding, tax strategy, and estate planning, so every dollar has a purpose. Every dollar has a timeline and a reason for where it lives. So as you end the year, take this with you. No plan is a wish, and wishes don't come true without a plan and a focus. Before the calendar flips, take control. Visit our site, mergentadvisors.net. That is MERGENT, mergentadvisors.net, and schedule a year-end review. We'll help you make small discipline moves now so that you can enter 2026 positioned, protected, and intentional. Because crash diets fail, resolutions fade, but smart money always plans.
Awesome. Well, thanks for coming on, Doug. That's the show for this week. Thanks again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. on our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a sharding and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you products and services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do.